Let's begin by understanding why the link between human capital and economic growth is so crucial, especially in Pakistan. Despite education being a proven driver of long-term productivity, Pakistan invests only about 2% of its GDP in education, one of the lowest rates worldwide. This raises a fundamental question: does spending on education actually translate into economic growth? Both neoclassical and endogenous growth theories argue that investing in education boosts worker productivity and fuels development. This study sets out to examine whether these theories hold true for Pakistan and if increasing education spending can truly drive the country's economic progress. Analyze the impact of human capital. The study builds on the Augmented Solow Growth Model. This model goes beyond traditional frameworks by treating human capital, essentially the skills and education of the workforce, as a separate factor of production alongside labor and physical capital. The neoclassical view suggests that education raises worker productivity, shifting the entire production function upward. Meanwhile, the endogenous growth perspective highlights how knowledge spillovers from education can generate sustained, long-run growth. By integrating these theories, the study provides a robust foundation for exploring how education investment can shape Pakistan's economic future. Like earlier studies that use simple proxies like years of schooling, this research introduces a weighted education index. This index reflects the distinct economic returns of different education levels: primary, secondary, technical, college, and university. By using annual time series data from 1992 to 2014, the study captures a more accurate picture of how human capital affects economic growth. The methodology involves assigning different weights to 7 educational tiers based on their estimated economic returns, then applying advanced econometric techniques to test for long-run relationships. This approach addresses previous gaps and provides more relevant insights for policymakers. Results are clear: human capital has a positive and significant relationship with real GDP in Pakistan. This supports the idea that educational investment is a key driver of economic growth. However, the study also notes a caution: some econometric tests show inconsistent evidence about the long-run relationship, so results should be interpreted carefully. Policy recommendations include increasing public spending on education, especially in underserved rural areas, expanding technical and higher education, and using weighted metrics for better policy planning. These steps can help Pakistan and similar countries maximize the economic returns of investing in human capital. In summary, this research makes important contributions both methodologically and empirically. It proposes a more nuanced way to measure human capital and provides evidence linking education investment to economic growth in a developing context. At the same time, it reminds us of the importance of transparent reporting and careful interpretation of econometric results. For policymakers, the message is clear: investing in education, especially with targeted and weighted approaches, can unlock significant economic benefits. But ongoing research and transparent analysis are essential to ensure these policies are truly effective.